Nvidia is doing something no company of the semiconductor industry has ever attempted. It is using equity, debt guarantees, and revenue sharing to turn itself into the financing core, supply chain hub, and system-level solution provider for global AI infrastructure. This is not a technological breakthrough, it is a redefinition of the business model. But if this model fails, it will also become the largest risk exposure in the semiconductor industry. 1. Nvidia is completing a systematic upgrade of its business model. The core direction is to upgrade its products from individual chips to complete systems, and to upgrade its revenue from one-time hardware sales to ongoing compute revenue-sharing income. In July 2026, Nvidia officially launched a new commercial arrangement. Through a revenue-sharing and credit support model, AI cloud service providers can obtain large-scale GPU compute capacity, then provide compute services to startups, model developers, and enterprises. While earning hardware sales revenue, Nvidia also shares cloud service revenue with cloud providers. Over the past 16 months, Nvidia has completed approximately $90 billion in ecosystem investments, covering more than 145 companies across the AI industry chain. Last week alone, it completed 3 large-scale deployments. It is in talks to provide OpenAI with approximately $250 billion in financing guarantees to help it lease the 10-gigawatt data center SoftBank is developing in Ohio. It plans to invest $1 billion to purchase new shares in South Korea's Naver, obtaining an approximately 4.5% equity stake. It announced with SK Group an AI data center cooperation plan exceeding $500 billion, including HBM cooperation with SK Hynix. The common purpose of these moves is to use equity to lock in long-term customers, guarantees to leverage incremental demand, and ecosystem investment to control the supply chain. This model uses relatively low capital commitment to leverage enormous infrastructure projects, avoids the valuation game risks associated with direct equity injections, and at the same time, locks customers' future capital expenditures onto Nvidia's platform. 2. Market contradiction. Fundamentals are extremely strong, but the valuation logic is shifting. Nvidia's financial fundamentals remain extremely strong. Revenue in Q1 of fiscal 2027 was $81.6 billion, up 85% year-over-year. Data center revenue was $75.2 billion, up 92% year-over-year. GAAP gross margin was 74.9%. Revenue guidance for the next quarter points to $91.0 billion. But at present, the stock price is hovering near $200, and its market value has evaporated by about $1 trillion from its peak. What is truly suppressing the stock price is the market's systematic questioning of AI ROI. Where will Nvidia's customers get their money from? The 4 major hyperscale cloud providers are expected to reach $725 billion to $770 billion in combined AI capital expenditure in 2026, almost equal to the total annual operating cash flow of the 4 companies. The 5 largest hyperscale cloud providers will spend more than $1 trillion combined in 2025 and 2026. The Bank for International Settlements, BIS, has issued a warning. AI infrastructure may involve approximately 1.5 times to 3 times overinvestment. Once one operator comes under financial pressure, it may create chain reactions through financial exposures. Nvidia itself has also acknowledged this point. When launching the compute for revenue sharing model, the company publicly warned that data center financing plans could reduce near-term cash flow and increase customer credit risk. This is the core contradiction for current AI-related stocks. Fundamentals are extremely strong, but the valuation anchor is shifting from order volume to ROI. The market is no longer satisfied with asking how many chips Nvidia has sold. It is beginning to ask when the data centers behind these chips will be able to generate enough cash flow. 3. Trend judgment. 3 scenarios and 1 key signal. At Nvidia's current price of about $207, its valuation is at a 5-year low. The expected PE ratio over the next 12 months is about 17 times on an EBITDA basis, far below the 5-year average of 36 times. It is even lower than the S&P 500's more than 20 times and the Nasdaq 100's nearly 23 times. This provides a margin of safety, but it is not enough to drive the stock price upward again. The next possible trend is, before AI ROI is proven, the market may keep Nvidia range-bound between $200 and $235. On the upside, it needs to break above $220 on volume and hold that level. On the downside, it needs to hold the $200 round number threshold. The most important signal right now is customer earnings reports, not Nvidia's own earnings report. The AI capital expenditures, AI revenue share, and return on capital of Microsoft, Meta, Amazon, and Apple will determine the market's pricing logic for Nvidia. 4. Deeper implications. Nvidia is no longer just a semiconductor company. It is the financial core of AI infrastructure. It is using equity investments, financing guarantees, and revenue sharing to lock global AI compute demand into the Nvidia ecosystem. The essence of this $100 billion gamble is that Nvidia is using its own balance sheet to provide a credit foundation for the non-organic growth of the entire AI industry. This model runs smoothly during an industry upswing, but it may turn into systemic risk during a downturn. BIS's warning of 1.5 times overinvestment and the customer debt chain are the core risks the market is currently examining. If AI eventually delivers the promised productivity returns, the trillions of dollars in upfront investment will be covered by excess returns, and Nvidia will become the infrastructure standard setter of the AI era. If the AI ROI reckoning fails, Nvidia's $100 billion gamble will become one of the largest commercial risk cases in history. At present, Nvidia's most core change is that it has redefined its position in the industry chain, seeking to upgrade from selling shovels to digging the mine. Does this indicate that this AI technology revolution is about to welcome its first leading bellwether?